So if you think about the last 15 years since the financial crisis, the overriding theme of regulators has been to reduce, if not eliminate, systemic risk. And they'll never say it that way, but that really is what it's about. If you think about 2008, there was a vast concentration of risk. And all of the regulation since then has been about how do we distribute that risk. Some of it has been around stress testing and raising capital requirements. But a lot of it is around sets of activities and innovators that have come in to, when it became too expensive for banks after this, given the capital requirements to do things, now it's gone out into an innovative form. So consider credit. In the United States, back around the time of the financial crisis, 80% of all mortgages were originated by a bank. Today it's 20%. Last year and the year before, over half of all credit originated in the United States was done through some kind of private credit. So it's a distribution of risk. The challenge has been, and by the way, that is a very good thing if you think about it, because what we found in 2008, it was this concentration of risk, lots of leverage that wasn't understood, that led to everybody blames it on Lehman. It was more than just one institution, but a series of institutions that actually caused not just a global financial crisis, but an incredible global recession. So there's been a single-minded focus on that. The challenge is that you've got a lot of this innovation that's occurred. Lynn has referred to some of it, and it's not that the regulators have ignored it, but they've more or less said, if it's not going to create systemic risk, then I'm not going to really focus on it at this point. And true, it's not creating systemic risk. I mean, FTX happened, and somewhere between 2 and 3 trillion of value was destroyed, and yet we're all here, right? We didn't cancel because of FTX. So, but that doesn't mean that people weren't harmed. I mean, the last number I heard, there's 1 million investors or participants that were harmed. So part of this is there needs to be a change in regulatory mindset that, yes, systemic risk and avoiding it is very important, but there's other things out there. And how are we going to kind of keep up with this technology? The point on payments is a really important point when it comes to inclusion. And I think if you talk to most banks, they want to support this. They recognize that this isn't the business we're in, so I'm speaking for others. They recognize that the traditional bricks and mortar branch, somebody coming in, that doesn't make sense. It's not going to work in most parts of the developing world. But we've got to, we've then got to support that. We've got to have the banks competing with the technology innovators. In some cases, it's the technology innovators that are providing some of that underlying technology to the banks. Last, what I would say on this is the other thing to think about as you're thinking about this innovation is money has more than one purpose. We talk about it a lot in terms of payments, so everybody says, well, why not have all of these, whether it's a cryptocurrency or a central bank digital currency? But money and monetary policy also is used as a way to regulate economies. And that is actually a real dilemma for the central banks today. How do we think about a central bank digital currency and monetary policy? And what are we going to do about money supply and things like that? So part of what we need to think about as we move to this next level is that money has actually more than one purpose.